Hello and welcome everyone to Almus Market Mornings, your daily dose of global financial updates. Now, it's been raining in Mumbai continuously without any respite, but in the world of markets, there has been some respite from inflation. Yesterday, we had the US inflation data. The PCE came in lower than market expectations. Morning, JK, what can you tell us about this? Does it change Fed's outlook in any way?
Uh, it's too early to say, Swaraj. Good morning. And we ended one quarter, and we are simultaneously we have entered a new month. Although it's going to be uh, not really a new month from today, because most players would be overseas players would be taking it easy till Monday when the US Independence Day holiday is observed. Yesterday was a wild night for risk assets with the recession risk rising. In fact, the US Atlanta Fed's GDP forecast for Q2 is now at -1%, following the -1.6% final reading that was observed on Q1. Weak PCE figures were partly responsible for personal consumption coming below expectations at 0.2% versus 0.4% expected, and market gave this a lot of importance. And despite a big fall in the yields, markets were not supported. This is the slowest pace of consumption growth in 2022. Equities fell across, and S&P 500 as well as uh, Nasdaq had a very bad first half, historically. German yields fell about 18 basis points after German flash inflation came lower than expected. But again, that lower number in Germany was due to the government support, which actually artificially brought down the prices. So Europe's flash inflation tonight will be important. US yields fell after the PC core inflation number came lower than expected, and that saw the yields fall across the curve, like 5-year by 10, 3-year by 8.5 bps, etc., and 10-year by about 7 basis points. Uh, Also, what I failed to indicate earlier was that there was a big revision in the consumption figure of the last month, which actually added to the negative sentiment. Now, so markets are now more than looking at yields fall as a positive. They're looking at recession fears due to the slowdown in economic activity, and which will impact the corporate earnings. And Fed is not going to stop, even though inflation may be moderating. Fed is not going to stop raising rates until at least 3% terminal rate is reached. That is the reading as of now. China's Xiaxin manufacturing PMI today came surprisingly much higher at 51.7% versus 48.1% expected. That has helped the Asian market sentiment somewhat, although I mean not following the overseas markets overnight to the same extent. However, Taiwan is standing out by falling more than 2% today. That may be again due to the recession fears and demand for uh, the chips coming down, because the auto sector will be impacted. On the US dollar, yields falling sharply in Germany, and German inflation number coming bad, along with the bad unemployment numbers, although it was impacted due to a lot of Ukraine refugees being counted in the unemployed roll. The These were the reasons euros got sold off to as low as 1.0380. But again, that is a very sensitive zone, because we have seen euro bounce from 1.0350 to 1.04 several times, and this was another time when it has bounced, mainly lifted because of US data which came weak, and also US yields falling quite a bit. Markets confidence in Fed getting inflation back to target is now quite evident even as the economy goes into a slight tailspin. Fed funds pricing is now reduced the terminal rate to 3.48% from 3.59% previously. So we have euro that is bouncing from 1.0350 several times. Dollar yen also kind of making some strong resistance around the 136.80. Again, we are now down more than 1% from the GBP is not breaking 1.20, and dollar index has failed to build on its rally above 105 for the third time in a row. So all these are looking like, we can see a bit more meaningful retracement in the coming days. On the rupee, it has been consolidating in the last two trading sessions after the big move earlier in the week. Uh, yeah, rupee traders and the Indian market analysts are looking at the oil price developments, particularly after G7 is initiating measures to cap the oil price, and also the indications that the Iranian officials are now moving further into serious talks on the deal, uh, with the dollar index holding 105 and sustaining below it, and so far 79 not broken in onshore hours, and NATs reappearing with offers in the last 2 days. So we are in for a period of consolidation, particularly till the weekend or till Monday when the US, or till Tuesday when US comes back after the holidays. So, however, one should remember there's no change in the trend as far as the rupee is concerned. I consider this as a pit stop for the rupee before the next wave of weakness takes it beyond 79.50, unless we see any significant change in the oil price or the Fed rate hike expectations. I think for that we need to wait for the jobs report next week, as well as the very all important CPI numbers in the second week of July. Thank you.
Okay, thank you, JK. That was insightful as usual. And as JK mentioned, we have the Europe's flash inflation data today. That's going to hold some importance. And right now, of course, markets go into a period of consolidation as the US celebrates its Independence Day on Monday. But there is no change in the broader trend. There are recession fears which are making rounds of markets. Risk management takes precedence during such times. If you're looking for someone to manage your risk, you can check out our description and get in touch with us. That's it for today. Have a very great weekend, everyone. Thank you.